In this video, we're going to do a separate scenario. In lecture 6E, you saw we did sale with a sale on credit with discount taken, all right? So we're gonna do this exact same scenario, but we're gonna do sale on credit with no discount taken. And instead of having FOB shipping point, we're gonna change to FOB destination. And instead of having a return, which we had on 1.7, we're gonna have an allowance, all right? So the changes are no discount taken for this scenario. Instead of FOB shipping point, it's FOB destination. And instead of having a return, we have an allowance, so you can be introduced to that. Now, the interesting thing is the first three entries are the same. So the entry on January 1st, and January 5th are the exact same entries that we have up here for these, for this section. So you can go ahead and look at 6E, part 1, part 2 to see those entries because they're the exact same. So I won't review them again in this scenario, all right? And again, FOB destination, remember what FOB destination is? FOB destination is the seller pays the shipping cost, and it's a delivery expense. It is not part of inventory, all right? So when you, as a seller, sell to a customer, the accounting board says, look, that is optional, right? If I am buying inventory and I have to pay the shipping cost, well, I have to do that if I want to get the inventory to sell. But as a seller, you don't have to do that. You decide to do that because you want to entice your customer to pay. All right, so now let's look at this one. It says ABC Company receives an allowance for damaged goods of $100. So what is the difference between allowance and a return? In this scenario, what happened was that XYZ returned. So when you return goods, what's actually happening is you are actually taking inventory that you received and you're giving it back. You're saying to the seller, you're saying to ABC, hey, I'm taking these back. But an allowance is, okay, the goods were damaged or the goods were not up to the specifications, so XYZ is gonna keep the goods. Instead of sending it back to ABC, XYZ is gonna keep the goods, they're just gonna get a reduction in the cost. So in this scenario, right, you still have the same 5 widgets. XYZ still has the same 5 widgets, but they're going to get a reduction in price because of the goods, okay? So what is the entry? So let's think about what's happening to seller, right? So is anything changing in ABC's inventory? Is this transaction, this allowance, is this going to change the inventory, remember, ABC's cost? Is it going to make ABC's cost go down or make ABC's cost go up, the initial cost that they purchased? It's not. Right? So there is no adjustment to the cost. If we look up here for the sales returns, right, we had to adjust costs and then we had to adjust revenue. Well, for an allowance, we don't, because ABC is nothing's going to happen to the cost. What's going to happen is now we're going to debit sales discounts and allowances because we have an allowance for $100, okay? And then we're going to credit, right, accounts receivable for $100 because we're telling the customer you owe us now $100 less. Okay, the $100 that you would have had to pay us, you don't have to pay us because we're giving you an allowance. So an allowance, with an allowance for the seller, you only debit sales returns and allowances and credit accounts receivable. You do not adjust cost of goods sold. You do not adjust inventory because there's no impact there, right? That stays the same. Inventory, remember, is the cost you incurred to buy the items. That doesn't change. And cost of goods sold is moving that cost from inventory to the income statement. So that doesn't change. So whenever you have an allowance, you debit sales returns and allowances, you credit accounts receivable. But what about the impact to XYZ Company? Well, XYZ is still going to have the same exact inventory items, but the cost is going to be less, right? So if the cost is going to be less, what do we have to adjust for XYZ? Well, we're going to have to adjust inventory. We bring inventory down. There is no inventory adjustment account or anything like that. And then we also adjust accounts payable because now XYZ Company doesn't have to pay $100. $100. There's $100 less that XYZ Company that has to pay. So I want you to compare, when you look at the handout, the differences between the journal entries for an allowance and a return. One of the things you'll notice is for XYZ, when you have an allowance and a return, it's the same entry. You debit accounts payable, you debit inventory for whatever the amount is. So the entry doesn't change here. But for the seller, instead of having two pieces, where you have inventory and cost of goods sold and sales returns and accounts receivable, for the seller, it's just one. Okay? So an allowance, inventory doesn't come back to the seller. The buyer keeps the inventory. You just tell the buyer, hey, I'm going to give you allowance, meaning I'm going to reduce the cost. All right, so let's go ahead and journalize this. So for the seller, it's going to be debit sales returns for $100. So here we have 100, and I'm going to credit accounts receivable for 100. Okay, that's going to reduce the amount of receivables that I have. And for the buyer, I'm going to debit accounts payable for 100. Okay, and I am going to credit inventory for 100. Okay, that's it. All right, let's look at the next one. So freight charges of $50 was paid on widgets sold. What is the freight? It's FOB destination. FOB destination, who pays? FOB destination, the seller pays, right? So the buyer is not going to pay anything. So here, the buyer is not going to have a journal entry. There's no entry for the buyer because the buyer doesn't pay for shipping cost. The seller pays. And whenever the seller pays, this is going to be delivery expense, or you could say delivery charges, whatever it is. You do not adjust inventory, right? When the seller pays freight charges, there's no adjustment to inventory. Okay, so we're going to debit delivery expense here for $50, and we're going to credit cash for $50. Okay? That's it. We're going to debit delivery expense for $50 and credit cash for $50. That's it. Now, XYZ paid for these goods on the 19th. So this is past the discount period, right? Because 10 days is the 15th. So now we just have to pay for the goods. So the entry actually is a little bit easier, right? Let me put this down. The entry is actually a little bit easier. So now we have to just pay whatever is owed. So we go and we look at accounts payable. We owe $650. Accounts receivable here says $650, so it's just the full price of the 5 widgets minus the allowance, right? The full price of the 5 widgets for $750 minus the allowance. So we owe $650. So we're going to pay cash of $650, and it's going to clear the payable. We're going to pay cash. They're going to receive cash of $650, and that's going to clear the receivable, right? So ABC company is going to receive cash of $650, and they're going to reduce the receivable for $650. XYZ is going to pay cash of $650, and they're going to clear the payable for $650, and that's it. So you'll see it's a lot easier doing these transactions when there's no discount, right? I mean, it's for class purposes, for testing purposes, it's a lot easier when there's no discount taken. But if you're doing this in an accounting system, it's very easy because the system does most of the calculations for you, right? And the posting for you. So let's go ahead and post this here. So cash, the seller is going to receive cash of $650. So I'm going to put $650. They're going to clear the accounts receivable for $650. So I'm going to put $650. So my accounts receivable is now 0, and there's the cash. The buyer, right? We see the entry, debit accounts payable and credit cash, is going to lose cash for $650. All right. And then they're going to clear accounts payable for $650. So if we look at the accounts payable for the buyer is 0, the accounts receivable for the buyer is 0, right? Inventory, we had the adjustment, 750 minus 100 is 650, right? So that's exactly what we would expect to see here, okay? And if we take sales revenue, 750 minus sales returns and allowances, 750 minus 100 gives me the 650, which matches the inventory, all right? So this is the scenario when you have a sale on credit with no discount taken. We switch to shipping terms to FOB destination, FOB shipping point. So you should know how to do those freight charges, and then also make sure you know the difference between an allowance, the journal entries for an allowance versus a return. And then if you don't have a discount, then the payment is very easy. You just look at whatever the balance is in accounts receivable, and you pay cash for that amount. You clear the receivable, and the other side is cash. You clear the payable, and the other side is cash.